Did the Federal Reserve do the right thing in holding interest rates steady last week? Is Trump unduly threatening the Fed's independence? Are we even debating the right issues? You're about to find out. Hi, I'm Todd Sheets, and this is the On Wealth and Progress podcast. If you're interested in balanced, factually supported commentary for a better future, you've come to the right place. I thought it'd be a good time to take a break from our recent discussions of the artificial intelligence revolution, especially since, for a nanosecond or two, I almost started to wonder if AI is everything it's cracked up to be, which happened after running a search for what the CCPCP, Committee for Centrally Planned Coffee Prices, has determined is the appropriate cost of a mocha latte in the Tampa marketplace. And the AI screen gave me nothing in response to this search. Kind of like one of those early 1960s TV screens after the tin foil slipped off the rabbit ears. I mean, if I can't access whether the Coffee Open Market Committee authorized a 25-cent increase or decrease, how can I tell if Amy at the grind, who in reality treats her customers like extended family, is charging the centrally planned price? But as the doubt started to build, I just happened to search for what the Committee for Centrally Planned Advertising Fees has decided an attractive woman is allowed to charge for wearing blue jeans and a low-cut tank top while hovering over a heart-thumping Mustang in an ad for, what was that ad for? Anyway, the search screen didn't return anything on the committee's ad rate diktats, but it did offer up a diatribe from various self-appointed committees on whether young, attractive adults are allowed to exploit their assets for a buck or two, and whether or not other adults are allowed to show the appreciation for jean manufacturers like American Eagle that allow them to do so. Phew. To paraphrase Dumb and Dumber, just when you think society can't get any stupider, it goes off like that, and it totally restores your faith in our future. And just in case you've been doing something important with your time, like being on vacation with your children and your family, and you missed all of this, search Sydney Sweeney and you'll see what the brouhaha was all about. So, with my confidence in both AI and the future back in gear, I ran another search, this time to find out what the Committee on Centrally Planned Interest Rates, aka the Federal Reserve, was thinking about the appropriate price for short-term money. And lo and behold, the screen filled up like a Thanksgiving turkey with a wide-ranging discussion on everything from 1, will they or won't they lower rates, to 2, whether 1 or 2 members will disagree with the 10 or 11 who set the price of money for the other 300 million of us, to 3, how much should the Fed spend on their headquarters renovation when A, the country is already running World War-like budget deficits, B, the Fed itself has lost just shy of $200 billion over the last 2 years, and C, the portfolio of long-term bonds it has amassed supposedly on our behalf is over $1 trillion underwater. All of which got me to thinking, why are we debating potential 25 basis point moves and the theoretical independence of the Fed when we should be questioning why, after 2 centuries of unimpeachable evidence on the failure of central planning vis-a-vis markets, we are still allowing a dozen people to override the market-based signals offered up by billions and billions of market transactions. especially given that the Fed sets rates that affect everything from auto sales in Alaska, maybe I'm still thinking about the Mustang in that ad, to housing prices in Honolulu, to stock speculation on Wall Street. In future posts, we'll move on to some of the bigger issues here. But after a short break, we'll come back and focus on the Fed's recent decision to hold the line on short-term interest rates. As you might have guessed, I agree with President Trump that the Fed is an institution badly in need of reform, though we may have differences on what those reforms should be. I also agree that our objective should be to create an environment where sustainable, longer-term interest rates are as low as possible. But once again, I believe the path to that objective is different from the one the president seems to have in mind. To understand how to accomplish sustainably low long-term interest rates, we must first understand what the Fed, even with all of its overblown powers, can and can't do. What the Fed can do is set the rate for overnight loans made to the banking system. By determining the rate that banks can borrow, and hence profitably lend at, the Fed has enormous influence over short-term interest rates. According to the Fed's own self-aggrandizing theory, the Fed can use this lever to either restrain the economy when it starts to overheat, or to juice the economy when unemployment is too high, which makes it sound like the institution can do no wrong. Perhaps because during the Depression, the Fed failed in its original mission of stopping bank failures and then gradually redefined its purpose over time, we have more or less grown up with and accepted the notion that having a small body of federal bureaucrats micromanage the economy is a good idea. In fact, the Fed's full impact on the economy is so widely accepted and poorly understood that even the economics profession has largely bought in, hook, line, and sinker, to the institution's self-glorifying self-concept. And in a way, this is not surprising. After all, just as almost every young and ambitious politician dreams of one day becoming president, almost every similarly motivated economist likely dreams of one day becoming the Fed chair, i.e., the most recognizable and influential economist in the world. But in practice, the Fed's self-anointed economic powers have turned out to be disastrous on multiple occasions. We now know that the failure of the Fed to stop the bank panics was the primary domestic cause of the Great Depression of the 1930s, and that subsequent monetary mistakes were primary causes of the Great Inflation of the 1970s, the blow-off and collapse of the tech stock bubble in the 1990s, the housing bubble and great financial crisis of the 2000s, and more recently, the bout of inflation in the early 2020s. Now, if you'd like to learn more about this long chain of failure, you can go to my Substack on Wealth in Progress, Todd Sheets on Wealth in Progress, April 27th post called Fixing the Fed Part 2, A Punch Bowl Full of Problems. But for now, to summarize, what the Fed can do is use its control over short-term interest rates to try and manipulate economic outcomes, which unfortunately it has done to an increasing extent over the years, with an ever-growing string of disasters to show for it. Now let's contrast this to what the Fed can't do. What the Fed can't do is force private market lenders to make long-term loans at a given interest rate. The reason for this is simple. Buying a conventional bond locks an investor into a fixed rate of return, which is the interest rate on the bond, even as the investor assumes the variable risk of inflation during the time of their bond, during the time that they hold their bond. Let's look at a real short example. Suppose you buy a 10-year bond with a yield of 4% when inflation is lower than that. But then inflation increases over the term of your holding period such that it averages 5%. In this scenario, the purchasing power of your capital declines over time, which means that you're paid back in dollars that have devalued relative to the dollars that you loaned in the first place. Now, in fact, as even the Fed now admits, a more extreme version of this is exactly what happened to fixed income investors in the in the 1970s and early 1980s, when the Fed's misguided efforts to monetize chronic budget deficits pushed inflation up to almost 15% at its peak. Further, repeated instances like this in the 18th century finally caused investors to become so leery about lending to Europe's governments that Great Britain created what became the classical gold standard to limit the ability of central banks to print money. As we've discussed in recent posts, the United States remained on the gold standard throughout the long limited government era, which was from 1800 to 1930. And in fact, we operated without even having a central bank until 1913. What were the results of this period? Overall inflation was almost non-existent, and the economy grew at the fastest rates we've ever experienced, and all of this contributed to the greatest surge in upward mobility for working class people in history. So to bring this back to the current conversation, let's summarize what we've just talked about. Longer-term interest rates are primarily a function of investors' inflationary expectations, and inflation is predominantly a function of Fed policies. So, if we want to create sustainably low long-term interest rates, it is imperative that the Fed maintains market confidence in the institution's commitment to contain inflation. Now, this is especially important in times like these, when already high deficits put heavy borrowing pressure on the government, which simultaneously elevates the risk that the Fed will succumb to the same easy money mistakes it and other central banks have made time and again throughout history. So let's take another short break, and then we'll come back and look at recent Fed policy making, including last week's decision to hold rates firm. The fact is, for various reasons, the Fed has been running abnormally interest rates for the better part of over 20 years now. As we've covered in recent discussions, these policies have consistently failed to reinvigorate the growth we experienced before the Fed went down this easy money path. A variety of factors, including globalization, technological innovation, and after the Great Recession in the late 2000s, persistently high unemployment, all helped hold consumer price inflation at bay in spite of this extraordinary stretch of easy money. And when I say easy money, I mean interest rates that were extraordinarily low relative to prior historical norms. But when the Fed is running easy money policies, the money it's printing and putting into the economy has to go somewhere. And not coincidentally, the Fed's low interest rates have played a primary role in causing the housing bubble of the early 2000s, the great financial crisis, and currently inflated asset values. Now, things finally caught up with the Fed a few years ago when Biden's deficits and the Fed's continued low interest rates led to the worst bout of inflation since the 1970s. And the Fed was finally forced to push interest rates back up towards historical norms. But then, with inflation finally coming back down last year, there may have been some room for a small, maybe a 25 or 50 basis point reduction in rates. But instead of first securing victory over inflation, the Fed quickly reverted last year to the same preemptive rate reductions that caused the problems mentioned above. And instead of making a small reduction in rates during 2024 over a series of 3 different rate decreases, they reduced short-term interest rates by a full percentage point. Since then, inflation has remained stubbornly above the Fed's 2% target and has actually ticked up to 2.7% in its most recent reading. Now, on top of the already high stock values the Fed's policies have contributed to, we have seen recent signs of speculative excess in the markets in everything from so-called meme stocks to soaring prices on initial public offerings, and even a return of SPACs, or special purpose acquisition companies, aka blind pool financings. It's not yet clear to me that the Fed's policies have caused these speculations, but this is highly reminiscent of the early days of the market's excitement over the internet in the mid-1990s. And as I've detailed in previous reports, during that period, the Fed made the mistake of, after orchestrating the bailout of long-term capital management in 1998, it dropped the federal funds rate in the midst of an already frothy, not speculative, but frothy environment. And after the Fed made those rate reductions in that environment, the tech stock bubble went from relatively sane enthusiasm to unadulterated craziness. And then it collapsed in one of the worst market drops since the one before the Great Depression. So, given that we have a real federal funds rate that, because of the Fed's overly aggressive easing last year, is already low by historical standards, also because of the extraordinary importance of maintaining investor confidence that inflation will remain contained even amidst these record deficits and borrowings, and finally, because of the dangers posed by the risk that an ill-timed rate reduction could set off a bubble like we saw with tech stocks and with housing previously, I believe that, even taking into consideration the relatively weak jobs report on Friday, the Fed this time made the right decision in holding rates steady this past week. In fact, because of last year's overly aggressive rate reductions and the recent uptick in inflation, if inflation doesn't come under control soon, and with all the borrowing and the deficits we've talked about, the risks of additional increases in Fed rates may well outweigh the likelihood of further cuts. We'll just have to wait and see. But all of which is enough to make me want to go pick up a comfy pair of pre-washed American Eagle jeans, stop at the grind for a mocha latte to go, and come home and cue up Dumb and Dumber. If nothing else, it'll be good for a laugh and will at least remind me that for all we've failed to learn about the disastrous idea of centrally planned interest rates, we've at least learned how to make TVs that aren't dependent on the tin foil staying on the rabbit ears in order to get a clear picture of what's going on. Today, we face important challenges, but none that are greater than those we have overcome time and again throughout our storied history. Here's to hoping your day is as bright as America's future. I'm Todd Sheets, and thanks for your interest. If you found this helpful, please subscribe and recommend it to at least one other person. If you'd like to learn more and to find links to my On Wealth and Progress newsletter and my book, please visit my website, ToddSheetsWriter.com. Thanks again.